and welcome to Real Estate Today. I'm your host, Laura Harbison, broker-owner of Realty Executive Southern Nevada Properties. Today, I have a special guest, Matt Hennessy, mortgage advisor with Benchmark Mortgage. Yep. And we are here to talk about what makes up the interest rates for mortgages. I've been getting a lot of questions asking me, how can the Fed rate go down but the interest rate go up? Those types of things. There's a lot of different factors that play into that. So I brought in Matt to explain that to us today.
Absolutely. Yeah, one of the major misconceptions that we hear all the time is, hey, the Fed just either raised the Fed funds rate or cut rates. How does that impact mortgages? So if we go a little bit back here in time, right before COVID, the average interest rate on average about 4%, give or take. Well, when we started to see inflation take off, you have to realize that the number one arch enemy for mortgage rates is the inflation rate. So if inflation takes off, a mortgage bond, which is really what mortgage rates are, they're mortgage-backed securities. They're traded on Wall Street. And whenever you think about, hey, what impacts mortgage rates, if we know that the bond investor, at the end of the day, if I lend $100,000 out of a rate of 4%, for example, that bond investor gets $4,000 at the end of the day. Unfortunately, if inflation takes off and that bond investor starts to spend money of $4,000, he only gets a certain amount of goods. So if inflation increases, unfortunately, the bond investor has to raise that Fed funds rate. So let's go back to the very beginning is the Fed funds rate was sitting at 0% for many, many years. So as inflation took off, the Fed quickly raised that Fed funds rate to about 5%, 5.25%. And you and I all saw our home equity lines of credit, credit cards, car loans, short-term lending. That's what the Fed funds rate impacts, not mortgage rates, because mortgage rates are really impacted by that of economic reports like jobs. Anything that's really negative on the economy is going to actually, believe it or not, help mortgage rates. So if I can give you a little perspective of the last couple months, if you go to October, almost 1 year ago from today, mortgage rates were on average about 8.25%. Now the Fed said, hey, I know we've raised that Fed funds rate several times. We're now going to be in a position because we've seen certain economic reports showing that the economy is now in disarray. We're going to begin in 2024 cutting the Fed funds rate. Now, they really doubled down and started illustrating the fact that, yes, we're going to cut that Fed funds rate in the beginning of this year. Come September, here we are now in just coming off of the very first Fed funds rate that was cut. It was cut 50 basis points. What I have to realize is that most often, if you've ever heard of the term of buy on the rumor, sell on the news, or sell on the transaction, what we found is if the last 3 months mortgage rates were trending lower because we anticipated the Fed finally cutting that Fed funds rate. So here we are. Just a couple of weeks ago, they cut it by 50 basis points. Since that period of time, mortgage rates have actually started to decline. So unfortunately, the media came out and said, oh, the headline. Remember that headline? It always said, oh my gosh, rates just dropped. Everybody called Laura and myself, and we had to explain to them that was the Fed funds rate. That is, and if you really want to dissect it, the Fed funds rate really is the bank that lends overnight, very short-term funds. This is where banks lend overnight to another bank for short-term credit cards, car loans, not long-term loans like mortgage-backed securities. So they don't really move at the same time. Now, truth be known is when we did see that Fed funds rate announced, mortgage rates improved about 1.5% for the better part of several months. But as soon as that happened, believe it or not, for the better part of about 3 to 4 weeks, we've seen mortgage rates started to climb back up. So much, if we're being relevant, in the last couple of days, we started to see some information that the Fed is probably going to digest. And as we already anticipated, it's already baked into the cake that they cut it 50 basis points. We have 2 more Fed meetings in November and December. Right. And they were anticipating cutting another 0.25% each time. But unfortunately, we might find ourselves seeing that rates are sliding back up temporarily. Strong jobs report does not help the case. That happened here last week. And the conversations that you and I have to have with clients are, they are trending lower. They will be pulling back down. Just it takes a little bit of time.
Yes. So the main factors that actually influence the mortgage rate would be?
Well, a perfect example, what happened here this morning. So in the last 24 hours, we saw that some negative news came out. right? And the negative news actually helps mortgage rates because what we found is that more individuals raised their hands and filed for unemployment for the first time. That's bad news. It actually helps mortgage rates. But we also, at the same time, you have these economic reports that come out every day. And the economic report that we just recently digested was, hey, inflation ticked up just a little bit, higher than expected. And unfortunately, when we start to look at what impacts mortgage rates, every mortgage professional and consumers have the ability to do the same thing. They could look at a calendar of events every single week, and you can anticipate, is that good news or bad news for the economy? So if we see a bunch of good news for the economy, you have to realize that stocks and bonds fight for the same investment dollar. So if I thought the stock market was going to go fantastic because of all this good news, people pull their money out of the safety of bonds. That's where mortgage rates are, mortgage bonds. So they pull it out of the safety of bonds, stick in the stock market, mortgage rates get worse. So what you and I are going to witness over the next couple of weeks is not so much of taking the headline of inflation to move mortgage rates, but the job creation, because the Federal Reserve, as they meet 8 times a year, they're talking about how can I help the economy. If we think, for example, that there's not enough jobs being created, that might be a swaying factor, whether they're going to continue to cut that Fed funds rate in the coming meetings.
So, Matt, can you break that down for us in very simple layman's terms? What are just the basic things that are affecting what mortgage rate I would get today?
Sure. So over the last couple of years, we've all seen these headlines saying that mortgage rates have elevated to the highs we haven't seen in over 20 years. And that was due to inflation climbing from the very lows where the Fed has a target of keeping inflation in this little box of about 2%. It climbed all the way to 9%, quickly reversed, and now we're much, much lower. We're heading sub 3% today. So what does that really mean for a consumer? If interest rates climbed because of inflation and now they're trending lower, you and I on a regular basis are watching interest rates trend lower. So the average consumer that was on the fence here a few weeks or months back went through the process and was still a little nervous about stepping into the market at the inappropriate time. We have to guide them on saying mortgage rates trend to move very volatile. And let me just kind of base this on the factor of when we think about mortgage rates, you're looking at something as a bullet point. What is a rate today? Keep in mind, the time we look at an interest rate, it might be 8 o'clock in the morning, noon, 3 in the afternoon. They change quite often. So it's imperative for us to know the overall trend. So if they're trending lower, the average consumer is going to save where, a few weeks or months back, that sales price was a little out of reach. Now we have an opportunity to circle back with them and say, hey, this improved your home affordability. There's more of an opportunity for you to step back in the market and buy that dream home you're looking for.
Well, thank you, Matt, for breaking that down for us. It's been very informative. And thank you to our viewers for tuning into Real Estate Today. Our next episode, we will talk a little bit more about mortgage rates, what you should be thinking about, when you should be buying, not buying, et cetera. All the questions that I get asked 18 times a day. Our contact information is below. You can see my phone number, my website. If you have any questions in between episodes, I'm always happy to take information from our viewers to make sure that you're getting the questions answered that you want to know about. So thank you again. See you soon.